The bank's number is not your number. Let that sentence sink in because it is the single most important truth you need to grasp on your home buying journey. When that pre-approval letter arrives in your inbox, it feels like a golden ticket. The number printed in bold can be shockingly large, making you feel instantly wealthy and powerful. It's easy to get swept up in the excitement thinking, this is what I can afford. But that number is not a recommendation. It is a maximum limit. It is the absolute ceiling of what a lender is willing to risk on you, not a thoughtful plan for your financial well-being. The bank is playing a numbers game to protect its investment, not to ensure you can still afford to go on vacation or save for your kids' college. Draw a clear line in the sand between their number and your number. Your number should represent a safe, comfortable place far from that edge. Lender approvals can be dangerously misleading because they are built on a foundation of best-case scenarios and incomplete data. A bank primarily looks at what is known as your debt-to-income DTI ratio. They take your gross monthly income, that's your salary before taxes, health insurance, retirement contributions are taken out, and compare it against your minimum monthly debt payments on record. This includes things like car loans, student loans, minimum required payments on credit cards. The bank then applies a maximum DTI ratio, sometimes as high as 43% or even 50% in certain cases, to determine the largest possible mortgage payment you could theoretically handle. This is how they arrive at that big, dazzling loan amount. The problem is that this calculation is fundamentally flawed from a personal finance perspective. Firstly, it uses your gross income, not the actual net amount you take home in your paycheck. This is a huge difference. Your take-home pay is what you actually have available to spend on housing, food, and everything else. Secondly, the DTI calculation only considers the minimum payments on your debts. It doesn't know if you're paying extra to get ahead. There is a world of difference between the approval amount and what constitutes a comfortable payment, and understanding this distinction is the key to your long-term financial peace. The approval amount, as we've discussed, is a theoretical maximum calculated by a lender. A comfortable payment, on the other hand, is a real-world number determined by you. Think of the approval amount as the top speed listed in a car's manual. You might be able to hit it on a closed track, but it's not a safe or sustainable speed for your daily commute. Your comfortable payment is that safe, everyday driving speed that gets you where you need to go without stress or danger. To find your comfortable payment, you must start with your actual take-home pay, not your gross income. From there, you subtract all of your existing expenses and not just debts. This means tracking everything: groceries, utilities, transportation costs, insurance premiums, cell phone bills, entertainment, personal care. You also need to pay yourself first by subtracting the amounts you are committed to putting into savings, investments, and your emergency fund. What is left over is the pool for housing. Your comfortable payment should fit easily within that leftover amount. A truly comfortable payment gives you breathing room. To move from the vague idea of a comfortable payment to a concrete number, you need a simple, proven guideline. The best tool for this is the 28/36 rule. This isn't a complex financial formula. It's a straightforward set of guardrails to keep you on the safe side of affordability. It's been used for decades as a common sense check to prevent people from becoming house poor. When you get a mortgage quote, many people mistakenly focus only on the principal and interest payment. This is a common and costly error. That single number is just one piece of a much larger puzzle. To understand your true monthly housing costs, you must look at the complete picture, often referred to by the acronym PITI. This stands for Principal, Interest, Taxes, Insurance. In many cases, there can even be a fifth or sixth component to consider. Ignoring these additional costs is like planning a budget for a car, but forgetting to include gas, insurance, maintenance. It gives you a completely unrealistic idea of what you will actually be spending each month. First, you have principal and interest, the portion that repays the loan and the cost of borrowing. Second, you have property taxes. Lenders typically collect 1/12 each month into escrow. Third is homeowners insurance, again collected monthly and paid from escrow. Fourth, you may have private mortgage insurance if your down payment is under 20%. Finally, many homes have HOA fees, separate but essential to include. Let's walk through a simple, realistic example using round numbers to make the math crystal clear. Imagine a household that brings in a combined gross income of $100,000 per year. To figure out the monthly income, we simply divide that by 12, which gives us a gross monthly income of approximately $8,333. We will use this figure to apply the 28/36 rule and determine a responsible housing budget. First, let's apply the 28% rule for housing costs. Multiply by 0.28. The result is $2,333. This number represents the absolute maximum for total monthly housing payment, full PTE plus HOA. This is our first guardrail, and it's a firm one. Next, we must apply the 36% rule for total debt, a $450 car payment, and $250 in student loans. Their existing non-housing debt is $700 per month. Now multiply gross monthly income by 0.36, $3,000. Subtract the existing debts. 3,000 minus 700 equals 2,300. The 36% rule is slightly more conservative than the 28% result. We follow the lower number. So our target monthly payment is $2,300. A practical breakdown might be principal and interest $1,600, property taxes $400, homeowners insurance $150, HOA $150. Adding these up gives a total of $2,300 per month, right on target. Yeah. Once you have determined a comfortable monthly PTE payment, the planning is still not over. One of the biggest mistakes new homeowners make is failing to account for the many hidden irregular costs of homeownership. These are the expenses that don't show up in your mortgage statement but will absolutely show up in your bank account. A responsible budget must include a buffer for these inevitable expenses. The most significant hidden cost is maintenance and repairs. The water heater will eventually fail, the dishwasher will break down, the roof will need replacement, the AC can go out at the worst time. Set aside at least 1% of the home price per year. On a $400,000 home, that's about $333 per month into a repair fund. Account for higher utilities, electricity, water, gas, and new bills like trash and sewer. Plan for move-in expenses. Movers or truck, furniture, appliances, lawn care equipment, window treatments. Save in advance, avoid credit cards. Lifestyle changes matter too. Longer commutes, yard care, and rising taxes or insurance can increase costs over time. The ultimate takeaway, affordability is about more than just the mortgage. True affordability means you can absorb hidden costs without stress. Your goal is not the biggest house the bank will give you. It's a home that provides stability and comfort. A house should be a blessing, not a burden. Choose comfort over the maximum approval every single time. Subscribe for Real Estate Explained without the confusion.